Welcome to this webinar, our third that we will be hosting over the next fortnight. This one focuses very much on continental Europe. The other two focus on Israel and the Middle East. And the subject of this is what's the best route to raising capital in Europe? And for those of you who don't know me, my name is Nigel Silito. I run a strategic communications and research business called Insight Discovery. And we're behind this second annual report on third-party marketing companies, which this year has actually been titled Making Third-Party Marketing More Mainstream. So maybe Sudhar, could you please show the slide with a copy of our report? So I'm delighted to say that we have some very respected partners behind this, which includes, for example, the logos you can see at the bottom, GemCap, RBC, and also three very established third-party marketing companies who focus on Europe, and that includes Active Fund Placement, that's for Germany, Garnell in Italy, and Capital Strategy Partners in Spain. So without their support, this project and these webinars wouldn't have been at all possible. So thank you. And I will introduce the speakers behind this project literally later on, because we obviously have them all as guest speakers today. So what I thought we would do is focus initially on some slides from our annual research study, where we interviewed over 70 third-party marketing executives, which is about 20 higher than last year. And this is very representative of the sector, because in total there are, believe it or not, some 210 firms active in third-party marketing throughout EMEA, Asia, and Australasia. So we managed to get a very large percentage of them to participate in this annual study. And what I'm actually going to do now is just run through some of the highlights from this study. And for once, and this might surprise people who know me, I'm actually not going to do much talking, because these slides are pretty self-explanatory. I'd rather the focus actually be on the third-party marketers who are involved with this webinar, and also our platinum partners from GemCap and RBC. And if you do have any questions, please remember to use the chat box, because I'd rather this was as interactive as possible, rather than us just going through slides and turning it into a lecture. So we will, I promise you, go through as many questions as possible from the audience, which I'm pleased to say is growing by the minute. So the key takeaways from our study, which was largely done online here, are highlighted. And I'm not going to go through each one. If you could just take the time to look at the answers before I move on to the next slide. Okay, Sudhar, if you could please move on to the next slide. So there are about 6 or 7 slides now. As I said, I want to try and keep this to a minimum. The first question, and there were about 20 in total, and I'm sure that some of you who actually participated in this study will recall the questions, was how many asset management companies does your firm represent? And here are the answers. And what's quite intriguing is if you look at the gold bar of the gold section of this pie chart, there was a decrease from the previous year. Sudhar, if we could now move on to the next slide, please. And how many managers do you represent in multiple jurisdictions? And obviously the vast majority of the TPMs we interviewed do have managers in multiple jurisdictions. Then there was a question about which type of asset management companies do you represent? And here we could ask people to rank as many as they wanted. That's why the numbers don't add up to 100. But clearly, many of them do represent, as you might expect, equity managers. But when you look at the results compared to the previous year, there were a growing number of TPMs who are representing alternative managers, which may not be a great surprise to everyone on this webinar. This was, I think, a very intriguing question. What is your fee model? So here we had some very interesting responses where in 2001, 44% were a mix of retainer and success fee, whereas in 2022, it increased to 49%. And the other numbers obviously haven't changed too much. And how much do you charge for the success fee? In 2021, 59% said it was between 21 to 30% of AMC, which is now in this current study down to 51%, whereas the percentage that charged between 11 to 20% has increased from 24% to 28%. This is also, I think, a very important question. When you look to represent an asset management company, which of the following criteria are most important? Remember, this is amongst the TPMs that we interviewed, and they said it's the reputation of the investment management company, which was even higher this year compared to 21. And then obviously, as you might expect, 26% saying past performance versus 22%. With marketing support being clearly down there, very insignificant as a factor. Next slide, please, Sudha. What makes a TPM successful in this current environment? This year, the top rank was 27%, the depth and the size of their network, but that was actually down quite considerably from 2021, where it was 38%. And the increase was in reputation, which went up 4 percentage points to 24%. And then marketing capability increased from 6% to 16%. So this is looking at what people take into account when, as a TPM, looking at investment management company. And then the next slide is is your firm regulating the countries where you market the investment strategies or funds of your clients? Not much difference on the yes question, but the no has gone down from 31% to 24%, which I think is quite interesting. Next slide. And if you do market funds and strategies across the EU, do you envisage any issues with cross-border requirements and methods? And 59% said no. So this is a question I might want to ask everyone later, because I know it is top of mind and growing in importance. Next slide. And then which channels do you focus on? Obviously, there are many different distribution channels in Europe: multifamily offices, pension funds, single-family offices, wealth managers, private banks. But rather than delve too much time into this slide, I'm going to ask the TPMs to look at, in their own countries, which of these channels are most important in Germany, Italy, and Spain. And next slide. As to who we interviewed, 43% of the people who participate in the study are based in continental Europe. 26%, no great surprise there, are in the UK. Then there was APAC, which is obviously Asia and Australasia, and this is the first time we've included them. There are very few TPMs actually in Asia because the regulations are so complex given the size of the area and the different regulators in each country. The majority are actually based in Australia and New Zealand. And then we obviously interviewed people who are based in Israel, and we're doing a separate webinar on that, in the Middle East, which is largely UAE, and the others comprises of South Africa and Switzerland, for example, where there are a great number of third-party marketing companies. So those are the slides. So I did promise to try and keep them to a minimum. And what I want to do is, as I said, now open it up to our guest speakers. So to start things off, let's go around Europe. And I think we'll start off with, just bear me one tick. Let's start off with Germany. So Guten Tag. Andreas, Andreas is the MD at Active Fund Placement in Germany. Welcome. And perhaps you could just very quickly introduce your business, please.
Yeah, thank you, Nigel. Yeah, Active Fund Placement, we are a regulated entity, which was one of the issues you just mentioned, in Germany, doing business since 2009. We have a broad approach, so we have a team of 5 people in sales, doing institutional sales as well as wholesale. I can go into more depth in a minute. So we cover everything except maybe retail.
Okay,
in the market.
got it.
And that's, Germany is the most important market. In addition, there's Austria, which is a lot smaller than the German market in total. And we do a bit in Luxembourg and Liechtenstein, which have ties to either of the 2 markets.
Okay, great. Thank you for that. And if you look at the institutional market, in particular in Germany, because there are so many different types of institutions, which ones are most dominant and which ones do you specifically focus on?
That's not so easy to answer because, as you said, there are quite some different players in the institutional space. I think that what you have to keep in mind, the institutional space in Germany is quite regulated. So it's for sure the area with the highest hurdle to enter. You have to be ready to provide all the necessary data in order for people to even consider you as a potential manager. And we work with consultants. We also work in direct relations with endowments, with pension funds. That is the focus.
Okay. And since we spoke about a year back, because obviously you joined our webinar, literally 11 months ago, have there been any major changes in the German market?
For the institutional business or in general?
Institutional.
It's a bit, I don't want to say business as usual, but it's still, when you look on what you see in the market today, it's a lot of global bonds, global equities. So it's trying to delegate as much decision as possible for some of those players. I think that reflects a bit the volatility in the markets. That's, if you want to see a trend, that's a trend. A second trend, of course, impact investing, no big surprise. Plays a more important role. A year ago, that was not really existent even in the institutional segment as a requirement. That has changed significantly. And yeah, then theme funds or themes in general play a more important role as they used to. Before it was more regionally allocated or global allocated, but nowadays we see specific requests for theme managers.
Okay. And what about the strategies which seem to be most popular with institutions in Germany? For example, which RFPs are you receiving? Is it in PE? Is it hedge funds? I know it's going to be very broad, but is there a common theme developing?
I would say you have to see, first of all, the German market is maybe different than UK or others, as equity plays a much smaller role on the institutional segment. So of course, then you have fixed income. Fixed income market is very difficult, as we all know. So there is the alternative space became more dominant than it was already. Liquid alternatives. We see requests for convertible bond mandates, and we see things like short duration, inflation-linked solutions. So it's pretty much a bit of a flight to quality at the moment.
Okay. And just my final question, if you're, let's say, small to mid-sized investment company looking to raise assets from Germany, what would you say are the do's and don'ts?
Maybe be prepared to that it takes a bit of time. It's quite competitive market, so you have to establish yourself. You have to make yourself known in the community. You have to offer something that is really unique, so a real value add. A Me Too product I would not suggest to enter at this stage. And then you have to make sure which segments you want to go, institutional, wholesale, and there are different requirements then for the different segments in terms of reporting or in terms of structuring the share classes. So make sure that you have the right value proposition for the right target markets.
Great. Okay. Well, thank you very much for your time. I'm sure I'll be coming back to you soon with some questions from the delegates specifically about Germany. So, ciao, Cor, Ducker, greetings. That's the extent of my Italian. Cor is founder and MD at Garnell Capital Partners in Italy. So, welcome, Cor. Perhaps you could just spend a minute or two quickly introducing your business.
Yeah, thank you, Nigel. We'll work on your Italian, don't worry.
Please.
There's some room for improvement, I think. So
I've been practicing it all morning.
Sorry for that, then. Sorry, didn't mean to insult you. No, thanks for the question. So we're a firm based in Italy. We have our head office in Milan. We're basically two senior partners covering all segments in the Italian market. Working for a select group of investment managers who are mutually complementary with their products. So we ensure that we have a suite of quality products that are mutually complementary that we offer to our relationships in the market.
Okay, great. And in Italy, which are the dominant distribution channels and which ones do you focus on?
Okay. Well, the Italian market, I explained it last time as well during this webinar. I think the Italian market is huge. So everybody speaks about the Italian debt, government debt mainly. But if you look at the country as a whole, actually it has a huge private savings pool. And that's primarily kept in by private persons. So if you look at the amount of wealth that is in mutual funds, it's about 1.5 trillion euros. So it makes it one of the largest markets actually for mutual funds in Europe. And most of these assets are concentrated with large banking and insurance groups, actually. So that's where the big chunk of the market, so the big volumes actually can be found. And next to that, you have a relatively young but growing institutional market space. So mainly first and second pillar pension funds that are, compared to GDP, relatively small, especially if you compare them to if you compare the size to the UK or the Netherlands, for instance. But they're an interesting group because they are developing quite quickly and they're growing. So that's definitely an area where new managers can actually find some space. And then next to that, you have endowments that are regionally spread across the country. And a growing number of family offices that are actually reshoring their wealth into Italy. So it's a relatively dynamic and growing market with a huge chunk of assets basically being managed by big financial groups.
Okay, and which channels do you as a business focus on?
We have very strong links with both these financial groups, so the wholesale segment, you could say, and with the institutional space, so with the pension fund system. We are more and more focusing also on family offices because, as I said, there's a huge amount of reshoring going on. A lot of money that actually 20, 30 years ago left Italy is actually getting back into Italy. And we're actually tapping into that growth area as well.
Okay, great, thanks. Please remember, by the way, we're getting quite a few questions through which I'll speak on later, so please keep sending the questions. And has anything really changed in Italy since our webinar a year back, whether it be from a regulatory point of view or perhaps new distribution channels coming into play?
Well, I think the biggest change is an ongoing. It's not a change in terms of market, but it's a dynamic, and there's ongoing concentration, Nigel. So what we do see is that there is the consolidation of especially of the banking sector is ongoing. So that we saw a couple of months ago a huge announcement of a merger between the two largest, or one of the two largest asset management organizations and financial groups in the wealth management space. So there is a concentration going on, and as I said, this reshoring trend from families, from wealthy families back into Italy. And what you also see is that there's more and more emphasis within the system of using this huge saving pool also to stimulate development within the country. So you're looking at more capital for venture capital initiatives, private equity, and the like. Sustainable energy, yes. So that's definitely a trend as well.
Okay, great. And what sort of RFPs are you generating at the moment? What's in vogue? Is it credit, PE? Can you give everyone a bit of flavor as to what's hot in Italy at the moment from a strategy perspective?
Yeah, so there's two main trends. I think one of them is touched upon by Andreas, which is obviously the current market volatility, which actually forces these players and especially wealth managers to look at ways to dampen portfolio volatility, to mitigate risks, and especially to look for a hedge against inflation. So that basically has led to a shift towards more absolute return type of products, specialist fixed income, which explicitly takes into account inflation in that respect. And recently, even hedge funds, fund of hedge funds, because it's been an asset category that's basically been dead in the water here in this market for the last 15 years. But it's something that's coming back now gradually, also given the recent results that have been more positive in that space. And next to that, as I said before, it's private assets. So a lot of focus on infrastructure, renewable energy, a bit of private equity as well, as long as these numbers hold up, I guess. Yeah, there is some movement on that space.
Okay, great. And I'm going to ask you the same question as Andreas. Let's say you're a US manager based in Boston looking to tap into Italy and raise assets. What are the do's and don'ts? Obviously, you're going to say, hey, use a company like yourselves rather than establish an office with all the costs and the regulation. So just quick summary, please, on the do's and don'ts from a boutique investment management perspective.
Yeah, the answer is a bit a copy paste of what Andreas said, I'm afraid. It's definitely a relationship-driven market, as is Germany, as I know, and that basically means that you have to be patient, you have to have a clear plan to enter the market, and you have to take the time to build the relationships in the market. So obviously we can help with that, but obviously you can also choose to go, your own and hire the people locally and do it like that. There's different ways to do that, but it does require patience. It's not a hit and run type of market at all, actually. And so that's definitely the advice I would give to these managers.
Okay, great. Thank you very much. Well, let's move on to Spain. So, hola, Ignacio Perez Penes. I probably pronounced your surname so badly.
No worries.
But welcome, and this is the first time obviously you've been involved in this project. So you're a partner of Capital Strategies in Spain, and also I'm going to maybe ask you about Latin America, because I believe you're quite active there. But for now, if we just quickly cover Spain, same question, what are the most dominant channels in Spain, and what does your business focus on?
Yes, thank you so much, Nigel. Spain is a bit different from other regions like UK, Netherlands, or even Latin America, where we don't have a pure institutional market. Okay, the institutions, the independent pension funds, are mostly embedded and driven and managed by the banks. Spain is a very bancarized system where there is only 4 to 7 pure independent pension funds. Okay, so it's not the most dominant channel that we do have nowadays in Spain. Going down, we have a dominant wholesale market with fund of funds, TPM, and insurance companies that are mostly driven through quantitative processes. And this is, we're talking about 280 billion euros nowadays. So it's one of the largest in Southern Europe. And going down, we have a very interesting retail network distribution that we go through the independent financial advisors and bankerized agents that we have in Spain, more than 6,000 agents. And this is quite important for a TPM business where you need to have resources, firstly, and a good service, because it can generate internal demand and will help TPMs like ourselves to put in place new ideas and new products from a bottom-up way.
And do you cover all these different channels within your business?
We do, yes. We have in Madrid, we have a staff of 15 persons here in Madrid, mostly of them dedicated to RM and sales. So we cover pretty much most of them, yeah.
Great, thank you. And turning to regulation, I know your business is regulated like everyone else on this call. It's pretty tough, I believe, in Spain. So what has your business done from a regulatory perspective?
Yeah, the CNMV is one of the toughest, I would say, regulators that we have within the EU, because it has some interpretations besides the typical MiFID II interpretations, okay? So going to our pure business, the CNMV interpretation of our business is that we put in touch an asset manager with an investor. That means that we are providing the RTO services, reception and transmission of orders. That means that providing such service, we need to have a fully regulated license. And we do have it via an agencia de valores. Therefore, we need to be accomplished with that regulation and have enough resources and externalized services to accomplish on that, okay? From our perspective, it's good because it allows us to provide our services overseas with a secure framework that it does within the EU. And in front of the managers, I do believe, managers and investors as well, I do believe that it gives pretty much comfort to conduct the business under the strictest possible regulatory oversight, okay? To give you an example, we all know all the agreements that we sign with the different managers, and one of the first things is if they ask in the agreements is that if we are accomplished with our local regulation, okay? So that's, I do believe it gives comfort to the asset managers, yes.
Okay, great. And what sort of investment strategies are popular in Spain at the moment?
At the moment, I would say that alternative liquid strategies, mostly in the merger arb, absolute return, some real estate is what people is looking for. Spain is a very conservative, so low volatility products within the fixed income arena and multi-asset is what is demanded. If you go down to the retail networks where they will need maybe less sophisticated products, equity products, active or truly active equity products will always be in the portfolios. It's true that in the last, driving these turmoils and curves in the market, in the last weeks, I would say, we have been seeing more demand from Tier 1 institutions moving into IG credit, and we do believe that high yield will follow it afterwards with the current situation of the spreads in the credit market.
Great, thanks. Just final question. Obviously, in Spanish-speaking Latin America, you seem to be active. For those watching, just quickly on LATAM, what are the opportunities over there?
LATAM is a very attractive market, especially for mid to large size asset managers, because in most of these countries, and I'm talking about the Andean region, Chile, Colombia, and Peru, plus Brazil, okay, even though that is more Portuguese speaking side, and there is quite good opportunities in those markets. It has some local requirements because of the size of the asset manager and the size of the fund. So sometimes boutique or niche asset managers cannot accomplish. But there's plenty of institutions out there and willing to invest into UCITS funds. It's true that in Chile, Colombia, and Peru, it has been challenging times in the last years because of the pandemic. Bear in mind that Chile, Colombia, Peru has pure private pension systems, okay? And the decisions of the governors, it has been to allow these pensioners to withdraw money from their saving in pension funds, okay? So in the last 18 months, pension funds has been adapting their portfolios due to this effect on the withdrawals. I mean, the system in these three countries, it's around 300 billion, and it has been reduced around 25% of their assets under management. While in the other side, we have Brazil, that is starting to open up and starting to access non-domestic investments. And it's a large country that it has, as of today, interest rates that is one of the challenging, but we're talking over 1.5 trillion industry, which is increasing nowadays, and it's a very attractive place to be.
Okay, great, thank you. A quick question for the three of you as third-party marketers. It's saying, is it commonplace for third-party distributors to continue to claim a fee from any investors which may invest in a fund for up to 12 months after any agreement between a fund and a third-party marketing company has ended? Who would like to answer that?
That's a good question. If I may, I can start. Yes, I do believe it's important to get paid after termination of any agreement. I would say that 12 months, it's the least that you can have. And we don't need to see this as an opportunity for any TPM, but it takes a while to build all this business, and we all know, okay, the time frame to enter into big institutions is a lot. So by having an agreement terminated, we do believe, and replacing that asset manager or that asset class for another alternative, we do believe that it needs to be paid as long as the asset manager is keep on receiving the fees from the investor.
Got it, thank you. And Core, Andreas, would you like to add anything to that?
Well, I couldn't agree more to Ignacio. So I think there would be otherwise a total mismatch and a moral hazard problem, because you do all the work, then it's successful, and then you are put out of the boat. So there has to be a balance of risk and return. Okay, got it. And Core, do you want to add anything?
Yeah, I agree with both of you guys. It's really a matter of aligning interests, and that's, I think, the key to everything we do for our clients. So our interest need to be aligned, and this is one of the elements in that process.
Got it, thank you. And a question for you, Andreas. In Germany, the main strategies are global bonds and global equities. This is an anonymous question. What about a mixed asset approach, blending the two asset classes in one fund? And would liquid alternatives include a L/S mixed asset strategy?
Mixed asset strategies work better in the wholesale segment than in the institutional segment, because on the institutional side, usually the asset allocation would still be decided at the asset owner level, while at the wholesale segment, often people want to have a one size fits all solution, or maybe they have a portfolio of 4 or 5 managers that do this mixed approach. And the second part of the question, LS and long short, I assume we talk about long short, is of course of high interest. We had in the past long short credit in the market, very successful. Long short equity is established also. It's the whole liquid alternative part is getting more prominent, more important, of course. And then you have to understand the mentality of the average investor is maybe also more conservative. So when we talk about long short, it's more like the drawdown is actually what people are looking at. Okay, great, thank you. Let's move on to our other key partners in the project, which includes GemCap and RBC. So thank you very much for your patience. Let me start off with Stuart Alexander, who's actually a very good friend of mine. I've known you, Stuart, for, gosh, I don't know, almost 40 years. And Stuart is founder and group CEO of GemCap. So welcome, Stuart. How are you doing?
I'm very well. Thank you for reminding me how old I am. Yeah, behind me.
You look fantastic for your age.
Well, the moisturizer is clearly working. Yeah.
So let's quickly talk about GemCap. It's obviously a manco. For those of you who are watching, you don't necessarily know what a manco is. Could you just describe what the benefits of a manco are to, let's say, an investment management company?
Well, just very quickly on that, Nigel, we're a fund platform as well as a manco. So you have to have the two together. So we have a funds platform, which where all the funds sit, and then you have the management company, which does the oversight and helps manage those assets. in short, and in essence, what a Manco is actually, we make life easy for investment managers. That's ultimately what we have to do to ensure that the whole infrastructure runs smoothly, in particular from a regulatory and an oversight point of view. And if you think about where this came from, when we first set up back in 2011, we were a self-managed investment company. So we were just the platform. And the regulator had made it pretty clear to a lot of platforms that they weren't happy with what had come out of the financial crisis. There's a lot of issues around the management of the funds by certain managers. And so they were asking for enhanced oversight of those platforms and the underlying funds. And so management companies started to come to the fore, to the point now that they dominate the market, and there's very few just self-managed investment corporations left in the marketplace. And what Manco does, it provides oversight of various parties, such as the oversight of the investment manager, fund distribution, the administrator, financial aspects, as well as making sure that we give confidence to the investment manager and obviously to the regulator that we know that what's happening is being done properly. And it helps also the investment manager to negotiate some of the complex regulatory regimes that are underway and make sure they're done properly. And ultimately, I guess the part of this is that we provide substance, which is necessary to help raise the capital that they're looking for across Europe and also globally. So it allows the fund manager to focus on what they do best.
And obviously your business is clearly based in Dublin, regulated there as well. So what's the appeal of, let's say, the Republic of Ireland? You know I'm going to ask this, over other jurisdictions like, let's say, Luxembourg. I'm
not going to have a go at Luxembourg, because I know Jeremy at RBC they've got a very strong Luxembourg business there. I've been involved in the Irish funds business now for probably 20 odd years. I've sat a number of boards over there, and I found that the Irish funds business, they do have a very sort of can-do attitude. Even the regulator, which is it's very rare to say these days, is actually proactive as far as ensuring the funds industry grows. It's a globally recognized area. Irish funds are sold literally in every jurisdiction across the planet. It's English speaking. It's a common law, certainly from a UK perspective. We recognise that, which is certainly different from Luxembourg, which is obviously a more of a mainstream European law jurisdiction. And it has a very strong financial services industry, and there's also a lot of companies there from multinational technology companies. So they're establishing themselves in Dublin, which means that, and it's something we can probably take to another seminar, another webinar, the whole investment in the workings of the funds industry takes technology, and the growth of fintech is massive in Dublin. So we're benefiting from that. So the point that we're trying to get this straight through processing, and the digitalization of our business is benefiting from this development in Dublin.
Okay, thank you. And from a Manco perspective, what's the benefit of working with a TPM?
Well, if I may, I'd like to talk about the benefits of the investment manager as well as the TPM, if that's okay. Let me deal with the investment manager, which I guess goes back to the role of the Manco. Every fund manager based in UK, Asia, US is trying to come into the European space. They want to grow their business without having to commit significant capital, and I mean capital in both financial but also in human costs. So I think it's in order for them to run their business, and we work now with some managers who historically had their own businesses over here in Dublin, and they've just gone, this is costing us too much time and money. So that means that they can give up a lot of that and hand that over to businesses like ourselves. There's less regulatory and compliance commitments, less risk and lower costs generally. I mean, one of our managers, we saved them €1 million on the day that they moved their assets to us, just in legal fees. So there are some massive benefits, and it allows the fund manager to focus very much on their core competencies. Administration is not an added value for a fund manager. Fund managers should stick to what they do best, which is run money. And having a Manco allows them to just focus on that, and actually having the benefits of then linking a Manco like GenCap to the third parties. And I'm glad to say that we work with all the third party marketers on the call today, and we've got great working relationships with them, as well as a number of other managers, a number of other TPMs. And the beauty about the TPM market is that they're specialists. They know their market very well. I often say, if they don't know it, they shouldn't be in the game. You know, it's like a sales guy doesn't know how to sell. These guys really know their business. It's a known cost base, so you know what you're working with. You're not driven by having to grow the business and suddenly have all lots of infrastructure around the distribution. It's there. It's a plug and play model which works really, really well. And it gives you access to quite sophisticated capital markets, which otherwise you may not know. If you're sitting in New York, how do you know what's going on in Milan or Frankfurt? It's impossible. So it's really, really important for you to engage with the TPMs so you get access to those markets, which may be less familiar to you otherwise.
Sure, no, good point. And obviously you're working with lots of different TPMs and investment management companies. So what aspects of cross-border distribution should investment managers, for example, be made aware of?
Well, I think this is going to be picked up by everybody here on the call today because it's relevant to everybody. Obviously, every market is different. I mean, we always smile with our US managers who look at Europe and think it's one country. And we go, hang on, there's one less than there was 5 years ago, but it's still a significant market, and everyone has a different requirement. You got to register different markets, and we advise managers not to register in every market. Focus on Spain, focus on Germany, focus on the Nordics, wherever it may be, but have a focus. But that means in some cases you can't do cross-border. You've got to be very careful who you work with to make sure you can do cross-border. So if you're a UK manager, you've got to make sure you've got a regulated business over in Europe who can help sell you that product. That's really important. The other thing to bear in mind is translations. Now, I think my colleagues here on the call will know better about this, but we've got like 150 different kids, and about a third of those got different translations on them. So there's a lot of costs associated with it. So just make sure you've got to bear those in mind. And then the UK MiFID, from a UK point of view, MiFID, you can't fly in and fly out anymore. So just be aware of that. Don't think you just nip across and go and visit Paris and happen to bump into half a dozen managers, wealth managers. You're not allowed to do it anymore.
Great, thank you. Just before I come on to Jeremy, thank you, that's Stuart. Someone's asked, with the turmoil in the markets, they sense TPMs are probably more in demand. What sort of capacity constraints might a TPM have when it comes to taking on even more managers? So which of you three would like to take that first?
Yeah, I'll take it, Nigel. I think it's an excellent question. It really depends a bit on the model that the TPM has. So we, for instance, have more of a strategic partnership model, and we work on the basis of a retainer and a success fee. And that means that every new partner we have has the right to get time from us. And that basically means that we are capacity constrained because we have the additional restriction that there can be no conflict of interest in the product range we offer. So there is definitely a limit for us to the number of players we can represent, and it depends a bit on whether they are niche or a bit more broadly in terms of product offering. But I would say for us the limit would be around 5 to 6 managers.
Okay, good. And what about you, Ignacio?
I agree on what Cor said. I mean, it's a matter of avoiding conflict of interest, be aligned with the manager, and as long as you put more managers on board, you need to put more resources. And that's why in the last years, we've been increasing, especially in our case, the team is both in Italy, in Spain, and in other regions. It's a matter of resources because you need to have the attention of the client. Yeah.
Okay, great. Andreas, do you want to add anything?
There's not much to add, really. When I listened to Core, it would have been the same, I would say. I think this non-competitive approach is the right way to go in terms of your partners. And then, yes, you have to be able to deliver. So that limits the number of partners you can onboard, depending on the size of the team you have, of course.
Great, thank you very much. Jeremy, sorry to have kept you waiting so long. We always like to leave the best to the end, so welcome. And for those who don't know Jeremy, he is the Managing Director and Head of Continental Europe, UK and Ireland at RBC Investor and Treasury Services. So welcome, Jeremy.
Thank you, Nigel.
Presumably you're in Luxembourg at the moment?
Yeah, just back from London. Yeah, I'm based in Luxembourg, so RBC, we are an asset servicer. We have offices in Luxembourg, Ireland, UK, France, Switzerland, but also Malaysia. So we support our clients when it comes to distribution in this country. So we don't do active distribution, but I would qualify ourselves as a distribution enabler, helping asset manager to bring on investor into the fund.
Sure, and I believe you tend to focus on investment managers, and there are many watching this who look after maybe 200 million up to 550 billion. Would that be correct?
Yeah, so we target mid-size asset manager where we can differentiate by the level of service we can offer. We are very strong shareholder services transfer agent in Luxembourg. So we've like, just to give you some example, we are connected to 10,000 distributors, 5,000 LPs. We process 47 million transaction, subscription, redemption, or capital call over the past 12 months. And we have investors that are coming from 110 countries. So that's why, I use the word distribution enabler.
Okay, got it. And what sort of services do you offer, let's say, investment managers and TPMs?
So like mainly if we stick to the distribution side, our role is to do the shareholder services component of it, opening a account, transaction processing, and then make it seamless. So having access to all these distributors and all these LPs help our client base connecting with new investor. We do also fund administration and custody, but less relevant for the conversation we're having today.
Okay, great. And obviously you operate in two major IFCs in Europe, Dublin and Luxembourg. So what are your thoughts on Luxembourg versus Dublin? It's only fair I ask you that.
So, like I'm first of all, I'm selling Dublin and Luxembourg. So, like, I don't think we should oppose the two jurisdiction. I think that I wouldn't repeat what Stuart said, but I think that's very true. In the two jurisdiction, you have, the right toolbox for some products. So sometimes, and we've seen that with Luxembourg. Luxembourg has been, for example, the big winner of the private asset. So with the right fund structure, and this has really blossomed and boomed. But UCITS brand, for example, recognized as well in Ireland as in Luxembourg. So like you would see Irish UCITS and Irish Luxembourg fund being distributed everywhere in the world. I would just say that it's a question sometimes of culture. It's a question of having the right legal structure, depending on the product you want to sell and where you want to distribute. I still feel that, like being two offshore jurisdiction recognized everywhere, again, it will really depend on your strategy and what type of product you would like to build. So that's mainly the decision factor for doing something in Ireland or Luxembourg.
I'm pleased to say more questions coming through, which I'll come to in a minute. But the final question for you, Jeremy, what do you consider to be the main distribution trends in continental Europe?
So what we see is, like private asset is growing, that's for sure. So this is becoming bigger and bigger. I think that what we see is now retailization of the distribution of these private asset funds. So definitively that's a trend, like having more of the retail as per the MiFID II classification of investing into a private asset fund where they had no access in the past. So I think that this is really booming, starting this day and will be booming over the next few years.
Great. Well, I really appreciate your insights and patience. Thank you. We have a question for the TPMs on this call. It's from Chris, and it says, I understand that TPMs get a share of management fees. What is the success fee? And is that the same as a performance fee? A hedge fund would charge a management fee of 2% and performance fee. Do TPMs share in both? So who'd like to answer that?
Maybe I can start from, we have different cases. I think it depends a bit on the setup of the manager. And usually if you manage to participate in the performance fee as well, you get a lower share of the management fee. That's at least our experience. So it's a bit of a trade-off of plannable income and more risky income. And when we go into more risk, of course, it should be a higher total amount on average.
Got it. Thank you. Andreas, sorry, Cor or Ignacio, do you want to quickly answer?
Nothing to add. Yes, the compensation scheme in the TPMs is based either on a fixed fee, which is the retainer, or either just based on success. Success means that if you raise money, you get paid. What? That percentage, either of the management fee or both management fee and performance fee. And I agree with Andreas that sometimes when you get performance fee, it will lower down the percentage out of the fixed management fee. Yeah.
Okay. I've just had a question in from Tony Van Gool, I'm sure some of you will know. In Germany, if a new entrant wishes to focus only on the institutional target market, i.e. family offices, etc., are not all on the wholesale retail market, is it necessary to obtain full distribution permissions, or does targeted private placement work?
I'm not 100% sure if I understand the question correctly. What you should do is register the fund for public distribution according to MiFID. So if it's an EU-based asset manager, it's a very easy process. So passport it to the German market, and then you can have a share class that has a high enough minimum investment, so you avoid any additional administrative burden.
Okay, thank you. This is a question from Roger to Jeremy. How are investment managers doing the realization of private equity? Are they creating an SPV maybe by pooling a lot of 100K euro investors into an SLP? So Jeremy, can you answer that?
Yes, so what we see is a different structure. So indeed, I agree to that model, but we also see LTIF being created, allowing for like smaller ticket to be invested. Some are also leveraging on other jurisdictions. So like in Italy, you could raise capital in this fund from 50,000 euros. So like it's just that the market is trying to be inventive. I think that I think there is a revised version of LTIF that is coming in by the end of the year. That will be certainly, if they make it right, that will be the easiest way to enter into private assets.
Great, thank you very much. I've just had a wave from Roger Nizar. Hi, Roger. Thank you for joining. I'm pleased to say that we've managed to cover some of the questions. If you still have some to ask, then please send an email to info@insight-discovery.com, and I'll share it with the speakers today. So I'd very much like to thank everyone.
There's actually there's a question coming in. It was from Richard Merrick, which is a good. Are sunset clauses still common?
Okay, who'd like to answer that?
I can take it. Yeah, I assume sunset clauses would be kind of cooling period clauses to prevent asset managers to terminate an agreement when there is something going on. Okay, so normally, yes, we tend to have some period of sunset clause, like 6 to 12 months, to disincentivize the asset managers to terminate maybe while you are entering into a big institution after a long time of work. Yeah, that's my view on this.
Great, thank you. Well, the third-party marketing is clearly an interesting subject because very few people have actually dropped off, and this has been an hour-long debate. So I really appreciate everyone joining and all our speakers. So thank you, and I'm pleased to say this report, which we've been working on, which includes the survey results, will be available from the end of our third webinar, which is the 14th of July. So we will be sharing it obviously with everyone who's participated and also far wider to all the investment management community. So that just leaves me to say thank you again for your time. Stay safe and have a wonderful summer break.